Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. This Labor Day weekend, we are revisiting two guests we interviewed 2 years ago before the financial system imploded. What they had to say is even more relevant today than it was then, if only investors had listened. Our first guest, Jason Zweig, is the author of Your Money and Your Brain, How the New Science of Neuroeconomics Can Help Make You Rich. Zweig, the intelligent investor columnist at the Wall Street Journal, reports on why our brains often drive us to make harmful investment decisions and how to overcome it.
One of the really astonishing discoveries to come out of neuroeconomics is that the brain has automatic formation of expectations. So once something happens twice in a row, you shall believe that it'll happen a third time. So if a stock goes up and then up, it's almost impossible for you not to believe that it's going to go up a third time. And Ben Graham wrote about this many years ago in The Intelligent Investor when he said the investing public is incorrigible. It cannot count beyond 3. And it's as if Ben actually anticipated this discovery of neuroeconomics. And that's important for people to realize too. You will perceive a trend so fast in the modern internet, financial television world where things are broadcast continuously in real time. You see ticks constantly. Our parents could only price their portfolios once a day, maybe once a week. We can do it 5 or 10 times a minute. And that leads us to perceive trends constantly. And most of them are just illusions.
Take us through some of the the basic findings. I mean, you've just mentioned some now, and then how we override them, if possible.
Yeah, a few of the other major discoveries that come out of this field are the power of surprise. The brain forms these automatic expectations very quickly, and then when those expectations are violated, what happens in your brain is sort of a revulsion response. In fact, one of the areas of the brain that activates when you lose money, when you've been expecting to make money, is the exact same part of the brain that lights up, if I can say this on the air, when you smell vomit or you step in dog poop.
I mean, it's that visceral.
It's extremely visceral. It's this incredibly powerful disgust response. But of course, what you're disgusted with is yourself. And that's why people so often, when they sell, in response to a drop in price, they sell at any price. They just want out. And then a few days later, a few weeks later, a few months later, they look back and they say, why did I do that? The stock has doubled. And so understanding that surprise can get in your way is very important. And the way you prevent that is with rules.
And that's a theme of basically of your entire career as well. And explain, how you can protect yourself from reacting emotionally and irrationally and actually hurt your investment performance.
Yeah. The key is, instead of making decisions in response to what the market does, which means you're permanently in reactive mode, instead of doing that, you put rules in place in advance and policies and procedures. One very simple rule could be never sell a stock purely because the price has gone down. Never buy a stock exclusively because the price has gone up. An even better rule is don't think of them as stocks at all. Think of them as companies.
That's right.
And
Benjamin Graham, Warren Buffett.
Straight out of Graham and
Right.
Buffett. And once you start thinking about them as companies with products and services, the daily price of the stock and those 40,000 fluctuations a day start to fall by the wayside, and you can maybe take a more calmer and more detached approach.
Our next guest, Nassim Taleb, is the author of 2 provocative best-selling books, which in retrospect are incredibly prescient. His first, Fooled by Randomness, showed how luck plays a much greater role in life than commonly understood. His second book, The Black Swan, The Impact of the Highly Improbable, shows how rare events are not as uncommon as we suppose and how significant their impact can be. Taleb is a PhD mathematician and a former derivatives trader. What do we as individuals need to know about, you know, the risk that that chance plays in our lives?
Yes.
The role that chance plays in our lives, and also what do we need to know about these unpredictable events that have, again, these life-altering consequences?
The first thing I tell people is most of you would not invest a penny in the stock market if you understood the risks. A lot of people take some risks, not because of courage, not because of informed decision-making. They take these risks because of ignorance. Okay, a lack of awareness and psychological blindness. Okay, some risk involved in finance. For example, they hear stories of, hey, the stock market yields 8% and annualized a year, so on, versus bonds 4%. Therefore, that's in their mind. Okay, they think that these 8% are going to come year after year. Okay, and assuming it's right. Okay, assuming the story is right. Okay, you still have some randomness around these 8%. You might get more some years, less other years. Okay, most people aren't investing while facing the consequences of not having a steady 8% return. If they knew the variation they could have, okay, they would not have invested in stocks. Now let's talk about investment that benefit from black swans.
Right.
There's a lot of classes. Typically, the classes of investment that have, effectively, I ignore these stories about stock market in general, to look at really what is it that produces return in the long run. What produces return in the long run is securities, where you tend to lose small when you're wrong, or investments, security investment, or ventures, and you can make big if you're right. Now, what are these?
What are these securities? Big upside, limited downside.
Technology. People, you know, poo-poo. I mean, people don't like talk down technology, all right? But technology, all right, has. You look at wealth, accumulation of wealth. Okay, these businesses seem to be volatile. These businesses seem to generally lead to bankruptcies. But you have a small probability of making a huge amount of money. Okay, so the businesses that I like are technology, biotech. I mean, think about it. Biotech doesn't seem to look good, but you have a small probability of a cure for cancer. Now, these class of investments, typically, they do not, they're not liked by the communities, all right? But they have been historically, okay, underestimated in their potential.
Okay. For an individual investor who wants to not just invest in their own business, which I know you think is the way that most of us are going to make money, is by investing in the stuff that we know.
Yes.
But for those of us who want a retirement that's more liquid or whatever, you know, I mean, we can't invest in venture capital. It's not open to us. So you know, so what do we do?
Okay. Basically, the first thing is negative advice: is invest much less in the markets because you don't understand it. I would say put 90% of your money in treasury bills and a broad, diversified, very short-term treasury bills. This is the money you don't want to lose. Now,
except you're losing it on an inflation basis. You're going to lose money possibly every year.
It definitely beats, all right, losing money. Okay, so with the remaining 10%, I'm not going to tell you what risk to take. I'm telling you you know, the degree of risk, which specific investment. Invest in as broad, as high a number, okay? Very diversified, very speculative things. Very speculative, very diversified. Okay, hopefully as many as you can.